All right, guys, this is being recorded. And one thing I say at the beginning of all these is watch it again because it will make it sink into your long-term memory, especially if you're newer to options or this particular strategy. Now, this strategy I know is a very simple one. It's probably one of the easiest strategies to set up. It's no-brainer in a sense. Well, at the end of the day, it does have a lot of things that go into it when you want to set it up correctly in the right time. I mean, you would never want to set this up in a low implied volatility environment. And they aren't going to tell you that when you look online to figure out how to do a short straddle. So it's really important, especially with this strategy, to follow these rules that I go through in this, because it can turn and get ugly quickly. So make sure you stick to the rules and, on exit and everything else. So I'll get into that in a little bit more detail, but let me get a couple of things out of the way real quick. My name's Eric Wilkinson. Some of you guys may recognize me as a Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've traded my own money for well over 20 years now. I actually started trading in college with some money I had earned working on farms and stuff like that. And when I went to college, this guy at the bank, when I deposited my money up there, goes, you sure you don't want to invest some of this money? And I took him up on it. So I started using their discount brokerage, bought some stocks, and then I started doing covered calls on those stocks. And then when I graduated from college with a finance degree, I moved up to Chicago to work at the Board of Trade. Started out as a runner, sold all my stock, bought my badge, backed myself, and started trading and haven't looked back. So in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. So I've been around the block. I traded from the pit and now onto the screen in a sense. So this computer was one of the first pin tabs, believe it or not. Anyway, got to go over this disclaimer. Any opinions, news, research, and analysis or other information contained here are provided by ProTrader Strategies and associated companies or employees, is provided as general commentary. It does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. At the end of the day, you guys, I'm going to be talking about stocks that are in my portfolio. For one, they're the stocks that I trade the most, and they're the ones that I have found have some of the best markets. So I'm not trying to get you guys to limbing off the cliff with me. I'm just trying to teach you some strategies by going through real life examples. And I'm also not going to cherry pick like you'll see a lot of these guys out there. All they do is talk about their winners. I talk about my losers probably more often than I talk about my winners. And that is so that we can show how to be mechanical. That's how you become profitable over time, is staying mechanical with these trades and really learning from our losers. So I talk about that a lot. Anyway, please remember that past performance of any trading system or methodology is not necessarily indicative of future results. You can also follow us on Twitter. Follow me on Twitter personally at Wolfman's blog, and our parent company at ProTrader Strat for all kinds of market wisdom or snark from me. All right, so this is how to use straddles to generate income. We're going to be selling these straddles in this particular webinar, so we're going to be collecting a nice chunky credit. So that's the beauty in this one, is that you get a big fat credit, and I'll talk about some of the rules that go into that. But first, let's go over what this short straddle really is. This is what it looks like on an Analyze tab, and simple enough. We're going to be selling the at the money call and the same strike at the money put. So we want to kind of set this up as a delta neutral, meaning, you'd sell 50 delta calls and then, I don't know why that says buy, that should be sell. That somehow got missed when I was looking over this. This should be a sell, the at the money put, and my pin's not working. So we're selling both of them to be sure. Why isn't this working? Is that showing up for you guys? Sell. We're selling these. All right, sell the at the money put. So we're selling both of them, and it's going to, if the underlying was trading at 40, we would be selling the at the money call and the at the money put. All right, and we want it to stay right there. I mean, it's going to move, and the probabilities are that even our break evens, which are going to come here, are going to get tested, and I'll talk about those probabilities here in a little bit. But you have to rest assured that that's going to get tested. Know your probabilities, and as long as you believe that it's going to kind of stay there, then you stick with this trade. Okay. Don't bail out too soon on it, because the likelihood is, especially with the short straddle, is you will be tested, because the likelihood that it never moves during the life of us having this contract on, or this strategy on, is highly unlikely. Anyway, picking the right strikes, I mentioned this. This is trying to create something delta neutral. Now you can set it up slightly different. Like if you think the market is going to move to a certain level and then settle down there, then that will work also. I don't usually set it up that way. I usually try and find a stock that is looking to settle down and then implement that strategy there. So you can do it otherwise, but I won't necessarily be talking about that. But if the underlying is trading at 155 and you think the underlying is going to trade up to 160 and settle down, then you could make this slightly bullish by picking those 160 strikes. Just know that you're not going to be delta neutral at the point of setting this up. And you're not going to always be really delta neutral, because the likelihood of you putting on this strategy when the underlying is trading 155 and you can do the 155 strikes, it really doesn't happen. So it's going to be off by a couple, but you want to kind of go to the ones that are as close to neutral as possible. Getting a question, do we look for high IV stocks? Absolutely we do. Anytime we're selling premium, we want to look for high implied volatility. And picking the right duration, we want to take advantage of theta decay, right? We want this theta decay to go down. And when we have high implied volatility, this is the reason why we want high implied volatility. For one, it pumps up the premiums and it kind of holds off that theta decay. And then when we get involved in this strategy, volatility reverts back to the mean, and we see this deflation happen in those premiums rather quickly. So one thing with the at the monies, it happens a lot faster, especially with like a strangle or something like that. With the straddle, it takes a long time for these things to decay, because the at the monies aren't going to decay as fast. So, but because we're collecting such a big premium on it, I'm going to show you ways of how we're going to use the rules to get out of this quickly. So I mentioned this, picking the right environment. We're going to be doing high implied volatility percent, the ones that have high implied volatility in relation to their own stock. Now, it's not talking about the VIX getting up to 15 or 20 or anything like that. It's basically each stock has its own implied volatility. Some stocks are more volatile than others, and we're going to be trying to pick the ones where it is in an environment where it has high implied volatility in relation to where it's been in the past. So every stock has its own implied volatility. Some stocks generally will be trading around 40, 50 implied volatility, but just because it's at 50 doesn't mean that that is high necessarily. We have to look at where it's been in the past and where it is now too. So for this, we're going to be looking at stocks above an IV percent of 50, or ETFs above a 30 IV percent. So the reason why we're going to look at a lower IV percent for ETFs is because it's a basket of them, right? And some of those stocks in there have really low implied volatility percent, and some of them will have a high implied volatility percent. So they kind of meld each other out a little, or average each other out a little lower. Picking the right underlying, this has to do with volume and open interest, you guys. We don't want to be trading something like even Snapchat. Everybody knows about Snapchat, but there's not a lot of people in those options right now. So we want to stay away from those stocks where there's not a lot of participation going on. And the reason why is because when the bid ask gets really wide, you have to give up so much edge to get in and so much edge to get out. You guys are going to be getting eaten up on giving up the edge to get in and out. I mean, if you have to give up a quarter to get in and a quarter to get out, well, at the end of the day, you're going to be looking at scratching all the time, scratching these trades, which means basically making nothing. And taking all that risk to make nothing isn't worth it. So one of my rules of thumb for this is a stock under $100. We want the bid ask on the option montage to be less than 10 cents wide. And on stocks over $100, we're just going to move the decimal 3 ticks to the left, and that's how wide it should be. So for instance, $500, $600 stock, we're going to move it 3 ticks to the left. $500 stock would be 50 cents wide. And you will find that some of the major stocks out there will have tighter markets than even that. A stock like Apple is $160, give or take. Those options are 3 cents wide, which is incredibly tight. So you don't usually have to give up very much edge to get in and out. I mean, you can really go mid-market or even sit on the offer because so many people are trading that stock those options that they are going to even hit your offer sometimes. Yeah. So can we look at Zynga, or is it Zynga? Over 300 IV. Shouldn't have over a 300 IV. I'll look at it for when you see it. Yes, we will be sending this recording out. And one of the things I said at the beginning here, and I'll repeat, is watch it again because I'm going to be going over some of these rules and they're really important to take note on. And I'm going to be moving a little bit too fast to really let you guys take notes, I suppose. So when you watch it again, you can take the time to kind of pause this. All right, so knowing our exit strategy, obviously one of the most important things to do. Knowing the exit strategy comes into play. And actually, picking the right underlying, before we even do any of this, picking the right underlying is probably the most important because then you don't have to go through all the other stuff. But knowing the right exit strategy before entering the trade, you guys, is going to come down to getting out early with this strategy. Usually with like the strangles or some of the other strategies, short options, just like the short call spread, I talk about a 50% of max profit. This one we're going to be taking a little bit less. For one, we're collecting so much. Two, it is a lower probability strategy. Even though I love this strategy, you need to get in and out of this quickly. So we're going to be accepting a little bit less, and we're going to be looking somewhere between 30 and 50%. If it happens really quickly, you get a really good high implied volatility one, and the premium comes out of it really quickly, you could probably get 50%. And one thing to note is with the straddle, it almost never it won't reach, just almost guarantee yourself, it will not reach the max profit potential, because if it's close to reaching max profit potential, one of those legs is obviously going to be in the money. At the end of the trading session, the stock is not going to probably be penned. If we were talking about the 155 straddle, the underlying is probably not going to settle 155 even, right? What's the probability of that? Slim and none, and Slim just left town. So we want to get out of this early. Don't write it into the end of the day. So 30 to at most 50% of max profit is where we're going to look to exit. And the other thing is I look at it like just pull the ripcord on this strategy if it's 2 times the credit received. So if we collect $2 and it's trading $4, just get out. Just forget it. Realize the probabilities of beating us on this one, and we're going to get out and move along. All right. And the other thing is to manage this one. We're going to manage this when our break evens are breached, and be mechanical with this. When the break evens are breached, the short strike that is out of the money, we're going to be rolling that Either if it goes down, we're going to be rolling the calls down, and if it goes up, then we're going to be rolling the puts up. And that's if you have a lower risk parameter. If you're really set on, hey, this is going to come back, you can stretch that out a little bit further. But and I'll talk about the rolling strategy here in a little bit. But we want to roll the one that isn't being tested, the side that's not tested and is out of the money now when our other break even is being tested. Okay, we're going to roll that down. And usually I look at if I can roll down and collect some more credit, I want to kind of cover that spread. So if I did the 55 straddle, let's say, or the 155 straddle, I collected $5. When it's trading down around 150 or maybe even 145 is usually where I will do it. I'm going to probably roll that down to the short calls down to 150. So now I've collected over $5. So if it does come back and I'm actually right and it kind of settles somewhere in between there, I've covered the width of those a little bit. It kind of limits the losses there. But by rolling, what it does is it also rolls down and out our break even. Okay. Okay. Al, yes. So we will be sending out the recording for sure. If you were joining late. So we're getting into the meat of it anyway, and I think you'll learn the most of it from when we pull up the trading platform anyway. So this is also when to exit or defend in a sense. Basically, what I look at for the exit is if you're in this trade for 10 days and you're at under 10 days and you're at 10% of your max profit, I should have like a less than. And you're at 10% of your max profit, get out of it. If you're, 15 days, less than 15 days, if you're in there for 13 days and you're at 20% of max profit, pull it. And I'm usually going to be looking at somewhere between 30 and 50% to get out no matter how many days. So don't want to ride this all the way into the last few days. I'm going to be pulling it out well before all of this. So, but if you have a higher risk tolerance than me, which is probably unlikely, you can write it out there, but I would suggest getting out early, especially with this strategy. All right, so max profit. Max profit is the premium received. That's what it always is. We're not going to look to go to a full max profit on this. At least I'm not. I'm going to be looking to get out somewhere around 30%, and I usually stick to around that 30%. If I'm lucky and something happens quickly where the volatility just kind of really comes out fast, then I'll do more, but it's not gonna. I'm not gonna. If I'm at 40% of max profit one day, say today, I'm not gonna write it out over the weekend and try and get a couple more pennies out of that thing. It's gonna get pulled quickly. All right. So max loss, keep in mind, this is unlimited. I will show ways to make this IRA appropriate. Right now, the way a real straddle is set up, it is not IRA appropriate because it is a naked short call. And, for some reason you can do naked short puts, but you can't do naked short calls in an IRA. Basically because the people making the rules don't understand options. And I will show how to do that, but to know our max loss is unlimited to the upside because of that naked short call, and it is going to be very painful if the stock goes to zero, which is where your max loss on the put side would be. All right, so our break even is a short call plus all of the net premium, okay, that we received on it. So the short call plus the net premium. And when I was talking about that 155 straddle as an example, and we collect $5, our break even is at 160, and to the put side, our break even is at 150. Okay, because you subtract the premium from it, because that's giving you room to the downside and the room to the upside. So we add it to the calls and we subtract it from the puts. All right, let's pull up the trading platform here. And this is usually when I throw it out for you guys to throw out some different stocks that we can look at to see if it fits all the rules. And Kip, I think, was the first one with somebody. So let's look at this. And I don't think I even traded this stock before. Holy cow! That see, in a sense, I don't know. I don't even know anything about this stock, to be quite honest. And when you're saying 300%, you're talking about the increase from here to up here, seeming three. When we're looking at it, it's actually less than 100%, even though this whole time every uptick is 100% implied volatility percent. The way to, and it has crazy, so you're getting the 300% by moving the decimal going that way, so it's at 337. But when we're looking at IV percent for something, generally speaking, actually the formula for this is you have a numerator and a denominator, and you take where the current IV is trading and subtract it from the low, and then take that sum and divide it from the high minus the low. So it's going to be somewhere in the 95 IV percent in a sense. But its current IV is through the roof. What does the stock do? So it's a $16 stock. The premiums are through the roof on this. So one thing I was going to say, so it's a $16 stock. So I said 10 cents wide, and because the implied volatility in this is through the roof, it's 94, but like you said, it's 300 and something as a IV, as implied volatility. So, which is right here. And it says that it could have a $19 move in either direction when the stock is trading. So it can go bust or it can go through the roof. So this is something I would love to sell premium around, but I think the bid ask is way too wide for me to want to get in and out of this one. And the fact that I have no idea what they do. But one thing I was going to say, when we're collecting premium with this, if you can collect, which we are going to be able to, if you can collect like 25%, if you can collect 25% of what the underlying is trading, that is really good, like really good. And this could be the best premium to underlying ratio I think I've ever seen, at least in a very long time. I don't think I'd be messing with this necessarily. I don't know what kind of news is coming out, or if there's a takeover for them at 30 or something like that, or at 40 or something. But anytime you can collect 25%, whatever this is, and that's almost, what is that? That's close to 75% of what the underlying is. Pretty crazy. But if you can collect 25 to 30% width, or 25 to 30% what the underlying is trading, so in this regard, it would probably be somewhere around $3 for this one. Then it's a good one. But I think I'm going to stay away from this one, Kip. Let's check out McDonald's. Shady Tree's back in the house. And he's got a pharmaceutical one for us. Probably, okay, so with McDonald's, $159 stock, right? So we want the bid ask to be somewhere around 16 cents. And lo and behold, it is. It's actually inside of 10 cents for these. These are about 16 cents. But it's inside of that rule for McDonald's. So it's trading 159.71. So we're going to be trying to pick the ones that are closest to the at the money, which are these 160 stock, or the 160 calls and puts. And as you can see, it's a negative 53 delta and a positive 48 delta. So that's pretty close to 50 delta neutral. We're going to be, because we're selling, the puts, a negative selling plus a negative delta means it's positive delta. And that's where it's going to be more positive. We're more bullish in a sense to the 160. And then when you're selling the calls, it's negative to a positive makes it negative, right? So we're negative deltas on the calls. All right, so the next thing to look at is its ID percentile, and it's only 15, which means when we're selling this, if volatility expands or goes higher, it's at a really low implied volatility right here. And when this starts creeping up, then that's going to hurt us because those premiums are going to go higher. Okay. Oh, that's info is for, it's a pharmaceutical. What do they have? Some kind of, that ZGNX is a pharmaceutical. Do they have some kind of trial going on right now where they're getting ready to release what the results are for that? I don't know. All right, so if volatility expands on us when we're selling premium, you guys, that is a bad scenario to be in because those premiums inflate, and we could be sitting there right there. It might never move from 160 on McDonald's, but if volatility just starts expanding in and around that, then that is not going to work in our favor. And as a matter of fact, we could start losing money despite the fact that we were directionally correct. So we want to start out with something that has a high implied volatility, something like these that don't have earnings either. I don't like selling this strategy around earnings, even if I was doing it the night before earnings to get that volatility crush that you see on earnings. So when like this has earnings, you can see what volatility does. That's what we want to see happen around this underlying, like get in around here and there's nothing going on and volatility just collapses for us. Or something like this where volatility spiked, would have been up in the 50 IV percent area and then collapses for us. So as you can see, volatility has a tendency, in a sense, to rally up. And McDonald's probably not the best example of that, but when volatility comes out, it comes out quickly. So we don't want to be experiencing the increase in volatility. We want to be taking advantage of the volatility crush that happens. Okay. All right. Does anybody else have any other ones, or I can move on to a couple that I've looked at? So I start over here on the side and start looking at stocks that have high implied volatility percent. One of the things that I talk about, if we look at like MasterCard, you know, I can see that it has low implied volatility percent, but it's not giving me the numbers here. And the reason why is because there's like a break in the chart here, which doesn't allow the software to come up with the calculation. It can't figure it out. So in those kind of in those kind of situations, you need to be able to figure this out on your own. And one of the ways to do that is using that mathematical equation of you take the current implied volatility, which is 0.15, and we can call it 15%, and 15%, subtract that by the low, which is 13. So 15 minus 13 is 2, and 2 divided by the sum of the high minus the low, which is, 25 minus 13, so 12. So 2 divided by 12. For some reason, I'm having a brain cramp on that. 2 divided by 12 is going to be, why is that not right? 15 minus 3 is 2 divided by the 12, and I am having a brain cramp. I'm sorry. Somebody got that for me? Brain fart, I know, 16%. I could not figure that out. 16%. So it's an IV of 16%, and I could have just cheated and remembered that it was over here. And I put this on. If you guys watch the daily market commentaries, I actually put on a long put spread in here today because it has low implied volatility percent. Okay, so let's look at somebody else said something. Okay, Gary, did I answer your question, Gary? Damo, I get them more being an old, yeah, I get them the more I'm being old too. And especially after a long day of doing math in my head all day, it gets worse. All right, so we can start looking at different stocks up here that have high implied volatility percent. I have it in my watch list. I add that over to the side there. And so I can easily look through this. In a sense, it's my scan. And if you notice, I list everything from high to low on IV percent. So I don't even look at the stocks. I just go down here, try and make sure that they don't have earnings. And Philip Morris does have earnings in this cycle that we're going to be doing. So I don't want to stick around with Philip Morris necessarily. At least I'm pretty sure they do. Let me just double check. When Philip Morris's earnings are. Yeah, so they come in on like the 20th, which is the 19th, which is the day before this cycle is, because this is that 45 days. We're right inside of that wheelhouse, what I was talking about. We wanted to get in here. So in that, with that earnings being in the cycle that we're trying to sell, we can see that volatility has a tendency to expand going into earnings, and we don't want to experience that. It's already started to creep up, basically due to some things that the FDA is saying about what they need to do with nicotine and things of that nature. So it's causing it to rally even earlier, and it'll probably continue on into the earnings season, so or the earnings cycle for this particular underlying. So we don't want to mess around with that. That's why I don't like selling this with. We want this to be a clean month like these months here, where we would be able to take advantage of the theta decay and not volatility expansion against us. So, so hold on, and then so check out AMD. You guys are loving the biotechs today, huh? Is this another biotech company? I haven't traded it, but it has low implied volatility again. And, like really low implied volatility. So we can go over here and look at it. It's an 8. The other thing, it does have pretty tight markets. It's only a $13 stock. And you would definitely, it would probably be close to being that like 25 to 30%. I'm going to set the puts. So we sell the calls and the puts, $1.78. So it's a little better than, what is that, 15% close of it. So I'm going to throw that in there. I'm going to keep an eye on this one. But it has a low implied volatility percent, so I'm not going to mess with that in and around this. They might even have earnings coming. I bet their earnings come outside of that. But having said that, they really spike going in. So this would be something where you would be looking at like a call spread or a put spread or something like that, where it's a long call spread or a put spread. Or show ones that works. Yeah, I agree with you. Let's do one that works. All right, so go back to the top. We're looking for Apple. Apple doesn't have earnings, has high implied volatility right now. I don't really see it going way higher or way lower from here. It could get a little bit crazy in and around the release of the iPhone 8. As you can see, I've shorted some calls in here because I don't think it's going up to 180 anytime soon. Anyway, but not trying to get you guys limbing off the cliff with me. But having said that, it's close to 160. We can look at the chart as well and say, am I biased towards the upside? I'm probably a little bit more biased to the upside with Apple than I am to the downside. So I'd probably lean towards the 160s then. And then sell the calls. And then we're going to sell the puts at the 160 strike. It's pretty close to delta neutral, 53.47. That's about as close as you get. And it's close with horseshoes and hand grenades. You're collecting $10. So now where's our break even? 160 plus the $10 on the call side is 170, and then subtract it from the puts, and our break even to the downside is 150. When you look at that, because it's got high implied volatility, that gives us a nice big range for Apple, $20 wide. So in a sense, right? 20 in 10 in each direction from where it currently is, 150 to 170 all the way up to here. That would be a really new high. Anytime they get up in these highs, you can see a lot of people want to take profits and stuff like that. So it could juke up and down and push up, but we're going to have a nice wide berth on something like this, 170 to 150. I like that. You can see it has high implied volatility. It doesn't have earnings in this cycle that we're in, and we could expect IV, implied volatility, to come back down to at least mid-range 50 or lower for this stock. So my expectation is for implied volatility to come out of Apple. It's gotten this spike in implied volatility basically because it's at those all-time highs, and now it's starting to correct a little bit. So I think that it's going to continue to start coming out of this. So that's what I like about that. So when's our exit strategy? One thing I talk about with exit strategies, you guys, is write it down on a piece of paper. When you put on a strategy, write it down, because you're more likely to stick to the rules than if you punch it out in your head. If you just put it out in your head, you are more likely to bend that rule. You're at 30% of max profit, and you go, I'm going to wait till Monday to get out of this. And that's usually when things start going badly. Just from all my years, it's like as soon as you start bending away from what you originally told yourself you were going to do, that's when it starts getting ugly, whenever you talk yourself out of it. And always go with your gut. If you're kind of like all of a sudden you're in this strategy and you're like, God, I don't know if I like this anymore, get out of it. Move on. Find one you like. Nobody ever went broke by taking profits, so take your profits early. All right, so we're looking at a $10 premium and times what is it? We want to take 25% of our max profit, so I guess I'll just do it by. I was going to do it by 7.5, but so $2.50 profit. So when this underline's trading, or when this decays to $7.50, that's where we're getting out. So if I can buy this back for $7.50, that's where I'm looking to get out. All right. Profits are better than losses. That's right, Domo. All right. Right. Yeah, exactly. Write down the plan and follow it. I am a huge proponent of that. So in this, when I put this trade on, I would write it down. I'm getting out at $7.50. If I can buy it back for $7.50, I'm getting out. I'm done with it. Now the other thing is what we were talking about. Let's say, for instance, this strategy we put on. We had put it on up here, and we had sold, let's say, when it was trade. Well, what was the high? 165. So the strategy was trading 165. When the underlying starts falling, and we're at $11, I would probably, when it's trading 150, that's when I would look to roll the calls down. Okay, and usually when the out of the money call is right around a 10 delta, in a sense, is kind of where I ballpark it when this market's moved against me, and these calls are about a 10 delta. They've decayed quite a bit, right? Well, what do you do then? You roll it down and collect some more credit, right? So I would be rolling the 65 calls when these 165 calls are about a 10 delta down too close to where it's trading currently. And usually what will happen is, if you're following these rules, I originally collected $10, $11 for this, and it's trading down below that. I'm going to be able to sell another call here, around $5. I would want to make my spread here 165 to 150. So then I've collected $15. I've covered that spread. It's inverted. You're kind of locking in a loss in that sense. You're staying mechanical, and if the market moves back up inside of that range area a little bit, then you're going to be looking at being break even on this. So you're not losing money in that sense. So you can play it that way. It increases your break even to the downside even further. But usually, if I'm going to defend this, it's when this strategy, when I originally sold it as a 50-50 delta, and it moves one direction or the other. If it rallied and the puts were about a 10 delta, that's when I would roll those puts up. Okay. So that's how you're staying mechanical with this strategy. You guys have any more questions about this? It's pretty simple in that rolling and things of that nature. When the market moves against you or moves out of that range, and either the calls or the puts now become like a 10 delta, we want to roll those down pretty close to at the money. But we kind of want to be looking at it like, have all of my credits, my original $10 credit, the credit I'm receiving now, is that covering the spread differential between the calls and the puts? In this regard, going 165, and I said it rolled down, so it'd be probably right, 3 ticks out, I'd be able to roll that down, collect another $5, and that $5 plus the original $10 would cover from 150 to 160, right? It's $15 total. That makes sense to everybody? I don't want to lose anybody on that particular segment of that. Try and have enough credit to at least cover that distance in the sense. And then, the other thing to do after that would be, if you still were pretty sure that it was going to be coming back to that 165 or 160 area, if it went against you, wherever your straddle was, if you're still kind of dead set on it coming back there, you could roll that out then in time, further duration, collect even more credit, increase your break evens, and then if it lands back in between those two, you would actually have the possibility of being profitable. Will you put on this Apple short straddle now? I can't do it today because of the close, but I was seriously thinking about putting it on today before the webinar, but I didn't want to look like I was trying to front run anybody else's opportunity or anything like that. So sometimes we'll pull the trigger on it if I really, really like it. I'll take the heat from people saying I'm trying to front run them or whatever. I'm not trying to do that. I'm trying to make my own money here too, right? I'm trying to trade my own accounts. So, and I'll talk about them in the daily market commentary. So you can always watch those too, because I talk about all those trades that I do. And why I put them on and when I'm getting out. So make sure you take advantage of those too. What is it? I like it. Do you think that this would work for the E-mini futures? Absolutely, it would work for the E-mini futures. I don't like to necessarily do. I'm kind of away from the futures these days, but I do use. I usually use like the ETFs and stuff like that. But yeah, it definitely could. Yes, Roger's asking you adjust when you're being mechanical and you're rolling down. You roll it down to about the 50 delta. Yes, that's where you're going to collect the most credit there. If you thought it was going to come back a little bit, you can. I mean, it's kind of like your assumption too, right? So if you thought it was maybe a little overdone, like the 30 delta or something like that, you could go down to. How frequently does this result in a loss? So it's right around a 75% probability of success with this strategy, okay? But by getting out early, you actually really increase those odds to about 80, 85% a lot of times. How do you get access to the daily market commentaries? Actually, so it comes with the premium membership, actually. And I do them every single day. And right now we're doing this premium offer. It's basically 2 months for the price of one. And you get those daily market commentaries. It's in here somewhere, but maybe it's not in here. You get daily market commentaries, which I talk about all my trades. When they're going against me, every single time I put them on, I immediately come out and tell you. And during earnings, I actually throw them out onto Twitter too, just because I do the market commentaries early in the morning, and then I do the earnings trades at the end of the day, towards the end of the day. So yeah, you get the daily market commentaries here. You get also access to all the trading videos, which is more than 50 at this point. Online access to the options trading lessons archives. We also have all these other kinds of 15 minute or so refreshers where I just kind of go over how to set up the strategy. I don't go into as much detail as I do in these webinars, like giving you the max profit and stuff like that. That's going to be found in these webinars here, or percent of max profit, I should say, and the options lessons. You also get access to me. You can email me if you have a question about a strategy that's going against you, or you wanted to throw something by me. You get access to me, and I am more than happy to talk to people on that stuff. I have a no inbox policy, meaning if somebody emails me, I'm emailing them back, and as fast as I can, because I know how it is when you have a bad trade on. You don't want to be sitting there like, twisting in the wind, in a sense. You want to, have somebody access immediately, and I'm good about that. I'm here all day long until the market closes. So after the market closes, you might have to wait a few hours or something like that. But during market hours, I'm really good about getting back to people. So, one of the things I talk about, and as a matter of fact, somebody asked me how frequently does this result in the loss. 75% of the time it's a successful trade, and when you're getting out earlier, it's a higher probability even than that, because you're out early. That's based on taking this strategy into expiration, basically to the last day. That's where those percentages come from. So when you're getting out early, you're increasing your probabilities tremendously. So I talk about that in all of my webinars and the daily market commentaries, all of that stuff. I talk about the probabilities of success. And I mean, you guys need to be trading with this kind of knowledge, because one of the first things that I learned, that's when I realized I really was becoming a professional trader, was when I stopped thinking about it as money. When you stop thinking about how much money you're going to make and how much this is costing you and all of those things, those are emotional drivers of trading. And once you can get away from that, once you can push that away, that's when you start realizing you are a real trader. And the only way to push those things away from you is playing probability, staying mechanical. And that's what I teach in all of these. So if you guys have enjoyed my instruction, and if you've learned anything at all, you guys should take advantage of this, because basically it's 50% off, two for one in a sense. And the best way to become a better trader, you guys, is to constantly learn. I've set up all of these lessons to help you guys learn and become better traders. I mean, you guys have obviously taken the first step by being a part of this and attending this webinar. But I mean, wouldn't you say that knowing how to create a straddle isn't going to be enough, or even trading the technicals isn't enough to create consistent winners? I mean, I know that you guys can go out there and read how to do this straddle, right? I mean, anybody can teach you how to do that. But at the end of the day, when we're talking about these different ancillary things, that the right environment to do it, you're going to increase those probabilities. So, I mean, basically what I'm saying is building a strategy or trading the technicals is one way to trade, but it's not the best way to get ahead in this game. And trading the probabilities and becoming more mechanical is. Anyone can teach you the strategy. I'm not going to lie to you. I mean, anybody can teach you the strategy, but they're not going to show you how to increase those probabilities in your favor. And that's what I teach, and that's how I play the probabilities. That's how I live by trading. That's how I've succeeded for, over 20 years trading. So, and when the probabilities have gone against us, how to stay mechanical, like teaching you how to roll those calls down when it's gone against you, and in order to increase those probabilities even further. So when you're trading with the right tools, you guys, in the right situation, you're going to be more productive state of mind, put on more strategies, which is going to create more opportunities and ultimately building your confidence. So we're offering this trial for you guys today. I suggest you guys sign up for it for this low price. It's a great deal. So go ahead and in the chat window there, I'm adding the link for this. So let me make sure I get it out to everybody. So I think I've learned how to do that. So in that link, go ahead and click on that link that I just added in the chat window and take advantage of it. And if you, like I said, if you learned anything today at all, what do you say? Go ahead and take advantage of that. We'll get you set up straight away. I think, was it Tristan Stronger said, did you say the probability is 60% on these trades? It's really, okay, so with the straddle, it's usually a little bit less, okay? But when we're setting this up in the high implied volatility environment, we're actually already increasing those probabilities, because part of the probabilities of success with this, and I'm saying it's closer to 75% of a normal strategy when you're taking it to expiration with the straddle, it's about 75%-ish in that high implied volatility environment. But when you take into account that we're only staying in this strategy for 10, 15 days and getting out, then that increases your probabilities even further when you've been able to get in and out of that very quickly. The link is in the chat window. We've been going back and forth in the questions. I think, can everybody see that in the chat window? I know I've done it incorrectly before, so I just want to make sure I'm doing that right. All right, so that's what we're trying to do, is increase the probabilities in our favor, right? I mean, low probability strategy, we take a little bit less than what we normally would to increase those probabilities. It's the best way to do it. All right. Also, for people that were watching this on tape delay, I know some people had to leave a little bit earlier, even though we were full. They probably weren't able to get back in. Premium subscription offer. Just type this all into your URL. You can pause it. It's also going to be right here in the red if that's easier to see. Basically, in later webinars, you guys, I'm going to be drilling down on different option components, when and where to trade them, all of those good fun things. If you guys have any ideas for future webinars, throw that out to me. I'd be happy to cover those. You can just email us at trading@protraderstrategies.com for that. If you have any questions at all, you can reach out to me at 310-598-6677, all right? So you can write that down, pause it, and punch that into your URL. But like I said, one of the things that's not mentioned here is you guys get access to me, which I know a lot of you guys take advantage of that, and I appreciate the give and take on those too, because it's good for me to stay on my toes. All right. That's about all I got for you guys. Thank you, Scott. Thank you, everybody. I appreciate it. If you can't take that, take it easy. JQ must have laughed. He didn't beat me to it. All right. Thank you, guys. Take care. Have a great weekend.